Welcome, everyone. Happy Wednesday, later edition. Thank you for being patient. Hashtag askrobco with James Wild. Hope you're all well. Hope you're enjoying the Euros. Good win for England last night. Qualified for the next stage, next round. So very excited for that. Unfortunate for all those Scottish people listening that they didn't make it, but let's hope Wales can perform for the home nations. The weather hasn't been as good as I would have hoped for, so that's taken a dip. But let's remain positive and hopefully that will return soon. How have you been, James? All good?
Yeah, really good. Thanks. Really good. Thanks, Rob. Fortunately, England last night. Good to see them get through the group stages and advance in the tournament.
Excellent. Let's hope it comes home. Right, let's go straight into the sales data this week. Handout number one and bottom right-hand side, and really, fascinating stuff happening on the sales side. We've been telling you for weeks that we're just seeing so much volume of transactions in terms of residential valuations. Our workloads are going up, and the timelines are stretching in all areas, from agency valuations to surveyors to conveyancing and legals. And the reason for that, and if you can see the headline numbers, week 24, the sold figures 383, and nearly doubled the amount where we were a month ago, or over doubled, and well above and beyond. If you look at the chart below, where we go through the last year and a few months, if you follow the yellow line, this sharp increase to that 300 plus number, and 383 just below the 400, that's the highest level of weekly sales volumes we've seen in the last year and a half. And I've gone back through the data and Intel archives here at MJ Group, and over the last 5 years, we haven't seen transaction volumes that high. And that is an absolute reflection of where the market is, where stamp duty window has driven the market, and the demand that is currently out there for residential property. Taken into consideration that new instructions dipped and are still consistent around the 350 mark. There isn't enough new instructions for the demand that is being required by the market. But these numbers are strong, and it's what we did predict and have been predicting. I'm not quite sure we expected it to be as strong as they are, but really, incredible numbers, I suppose, James.
Yes, phenomenal sales in the last week or so. We were predicting that there would definitely be an uptick in terms of the sales volumes for the month of June, with the stamp duty holiday on the first £500,000 coming to an end. Like you say, that 383 figure is the highest we've seen in the last 5 years or so. So it's going to be hard to beat that next week. This could be the peak this week, and possibly the sales are just going to dampen down more towards the late 200s, 300 in the coming weeks, as the stamp duty threshold gets reduced to the first 250,000. That's saving. As we can see the last couple of weeks in terms of the under offer properties, there has been quite a large pipeline of those 200 plus in the last 2 weeks, that dropping slightly this week to around 180 properties. So there is indications there that there's a pipeline of properties which are under offer, which are going to exchange, sell and transact in the coming weeks. So it's going to continue to be a busy period until the end of June, and there's no doubt going to be a lot of overflow deals which don't quite make the stamp duty deadline at the end of this month. And so we're expecting that to progress through into July. And then we'll see what the market brings then in a typically quiet period, the July and August period.
Yeah, I don't see them being quiet. I do think there's going to be an overflow. What a lot of the deals have been agreed as are different pricing depending on whether the deadline is met or not. So, as an example, if we complete by June the 30th, it is 500,000. And if we don't complete, then there's going to be a 15,000 change in that price to reflect the loss in stamp duty saving, as an example. So loads of deals out there like that. I do expect there to be a large overflow moving into July, and because the market is so buoyant, I believe that July and August will be strong months because there's just too much happening for it just to stop one day to the next. Caveat, historically, when you have had deadlines like this, the following month has seen a dramatic decline. So historically, yes, I'm super interested and fascinated to see if that's going to be the case in July 2021. I don't think it will, but it will be great. It'd just be great to monitor and see. It will be a real indication of how robust and how strong this market really is.
Definitely agree with that, Rob. And as we come into the autumn market, like we mentioned, hopefully this aligns with some of the lockdown restrictions of social distancing easing, which will no doubt bring more buyers into the market, with possibly international travel also. With those restrictions easing, it could see a number of overseas buyers who haven't visited the country in some cases for up to 2 years, and certainly 2 full summers. So maybe there'll be some autumn overseas buyers then. And if that's not the case, then we fully expect next summer to be extremely busy, as there will have been 2 full years whereby that prime central London market, those which do rely more heavily on the Middle Eastern buyers and overseas purchasers, could see a more active market.
I think on that point alone, the fact that the prime super prime has performed so well without those buyers, and arguably has been the leading super prime, London being the leading super prime market across the world. It's fascinating to see what will happen or what would have happened if those international buyers are able to come into the country, and whether that will fuel even more demand in that space that's already performing exceedingly well. And touching on that, with this excess of 2.4 billion of cash in the UK and savings, and the announcement yesterday of record growth for billionaires, up 27%, and record amount of millionaires as well. I'm seeing, whether it's in London, New York, Paris, and even in Guernsey, Jersey, Isle of Man, Gibraltar, Monaco, the jurisdictions, the prime market for those high net worths and ultra high net worths is performing well, because that excess money, that excess cash, that growth in income or savings is being put into property and real estate. And we are seeing a change in what, over maybe the last 5 years, has been a little bit of a stagnated market. That's not the case across the board in multiple jurisdictions and multiple prime markets in leading cities of the world.
Definitely, Rob. Just in terms of a bit of a poignant day today, it's been 5 years since the Brexit vote on the 23rd of June 2016. So I just want to take a very quick look back on how the property market has performed over this 5-year period and what's happened in the market. We saw at the time that the vote polarised the British public within the property industry and all sectors of people's lives, and there's a real stigma attached in terms of real estate to the potential prospect of leaving the EU. And let's just get your thoughts quickly on how you think the property market, in your opinion, has performed over the last 5 years.
Yeah, I think on the previous point that I made, I think that prime, super prime stagnated to a degree following Brexit because of the uncertainty that came with it. And, then COVID hit, and it's actually fueled that market, that's allowed it to perform well. Across the UK in general, the market was relatively flat. And again, COVID has fueled demand in that space. Nationwide, Halifax up 8-10%, with far greater demand now than actual supply, which is fueling those price changes. And then the whole nuance around the buy-to-let market and renters against buyers. We've seen rental decline. We've seen, I would say, when Brexit, although over those 5 years kicked in, was a peak in buy-to-let activity in the UK. You had something like 80 to 100,000 buy-to-let mortgage applications go through then. You've seen that dramatically reduced now by nearly 30-40% to around the 50-60,000 mark. And that's because mortgage relief has been lost, costs involved, taxes involved in investment and buy-to-let have been implemented. You've got the lowering of rents because of COVID. That means income stream and yields have been seen a downward trend. And the overall outlook in that space is there's a lot of people exiting because it's just not that easy to make the kind of returns that historically you've got. So lots of nuances, lots of changes, and the market's a real lifestyle market now. People are making decisions on footprint, locations, outside space. Working trends have obviously changed. 2 days in the office, 3 days in the office, a lot of home-based. So, I mean, I don't think you could have seen a bigger shift in 5 years than what we've seen, for some reasoning which could have been predicted, and some obviously that is completely unprecedented.
Definitely, Rob. I think your point about the different submarkets of the property sector is very interesting. How after that Brexit vote, we did see quite a subdued level of activity in the super prime market, whilst over the same period, the UK house prices have gradually risen. We go back to June 2016, the average house price in Britain was around £212,000 on a national level. Today, we're at around 260,000, according to the Office for National Statistics. So in that 5-year period as a whole, the market has performed reasonably well with steady growth. But like you say, there's been a number of changes to mainly the buy-to-let sector has really impacted the market. Like you say, those changes to the stamp duty surcharge, extra 3% for second home buyers. 2017, some of the tax relief changes. Then we had the new regulations in regard to property licensing for HMOs, selective licensing, additional licensing, all under the umbrella of the HMO property license. Just to bring in interest rates very quickly as well. During that period, we did have the economy was performing reasonably well. Philip Hammond was announcing 4 interest rate rises in around his end of 2017 budget, which obviously March 2020 interest rates fell from 0.75 to lowest ever levels of 0.1% in March 2020. So the market has had to be so reactive to all of these fiscal changes and both sort of regulatory changes in the buy-to-let sector.
Yeah, I'm glad you mentioned the interest rates. We've seen over the last week a bit of an interest rate war in the high street, sub 1%. Few of the big names have been branded around there, HSBC, I think, being one of them. That's an interesting space to watch. And also, affordability is a fascinating one. A year and a half ago, January, February 2020, it was more affordable, or at one of the absolute most affordable moments to buy a property rather than rent. 1.5 years down the line, complete reverse. Prices have gone up, whatever, 8-10% year on year. Rents have gone down. Now it's the most affordable time to rent, or more affordable to rent than it is to buy, and than it has been in the last 10 years. And that's a change in a year and a half, and COVID driven. So it's fascinating how the whole market, from renters to buyers, or from buyers to now renters in terms of affordability has turned completely upside down.
Definitely, Rob. And like we say, we go back to when people are working in towns and cities and more urban districts. Those people, it's often a trend, people live in smaller households on their own. But due to COVID, isolating, people have maybe the average people per household has maybe increased. People have maybe given up their leases on flats and moved in with family members or friends, which has obviously driven down the rental prices. And I think as people are returning to work and their lifestyle is going to change for a lot of people, for their sort of 100% working from home to being back in the office 2, 3, it's up to 5 days per week. So we do anticipate a bit of a correction there in some districts on the rental prices that are being achieved. Just
Brilliant.
touching on the interest rates again, Rob, sorry. Inflation has started to rise quite sharply in the last 2 months. In April, it rose about 1.6% year on year to it now being just above 2% in the month of May 2021 annualized. There's some calls for some interest rate rises, which are almost they're inevitable at some stage, with it being 0.1% for a period of around 15 months now. How soon we're going to see that, I'm not sure, and what impact that could have on the property market. But like you say, a bit of a war on the high street in terms of their competitive pricing for all their mortgage products. I don't know how that's going to impact the market in the coming months if there is an interest rate rise.
Brilliant. Thanks for that, James. What else have you got for this week?
So in the last week, we took a bit of a look on some of the average house prices in some coastal districts in the UK, with the most expensive of those being Poole near Bournemouth and the very infamous Sandbanks residence, which obviously right on the south coast, very highly desirable area. But just in terms of, like we've mentioned quite a few times, Padstow in Cornwall has actually seen the biggest average price rise of any of these seaside towns over the last decade. Last 10 years, going back to 2011, it's jumped from around £350,000 in 2011 to now being at £615,000 average property price in Padstow in Cornwall, going up over £250,000 in that 10-year period. The last few years, it's been a very popular second home area for some of the urban and city dwellers. Holiday homes, holiday lets, Airbnb, like we say, and it's whether that market is going to be able to sustain its popularity in terms of the UK choosing to go on domestic holidays rather than overseas holidays. A lot of the winter trips we've seen in the last 12 months people haven't been able to get that sort of overseas sunshine. They've chosen British tourist destinations for that. So how that market is going to continue to perform will be an interesting one as well, but has certainly been surging in the last 12 months.
Great. Anything else for this week, James?
That's it from me.
Brilliant. Great. Great data and great insight this week. Some of the headline information that is being brought to the market and what we're seeing is fascinating. The market is moving so quickly. I really don't think in my near 30 years of working have we had the opportunity to produce a weekly update and a weekly show where actually things move so fast that there is the need to provide the intel and the data and the updates to the marketplace every week, like we're doing. It's really unprecedented. It's a sign of the times, but it's also great that property and real estate and lending and finance has reached a level of transparency and openness where actually we have the opportunity to share our knowledge, experience, and all of the information that we're being fed to the wider marketplace, which is brilliant and great. Thanks for everything this week, James. Let's hope that next week when we're here, England are still in the Euros, and hopefully we can build a bit of feel-good factor back in the country, like it always seems to do when the football team produces. So let's hope for that. Have a safe week. Everyone take care. Thank you for joining on all platforms, YouTube, LinkedIn, here on the live show and on the podcast now as well. Multiple platforms to listen to this every week. Any feedback, any further information you want, any special content that you need or data, please reach out. Otherwise, we'll see you at 1 o'clock, same time next Wednesday. Take care, everyone.